Good afternoon, everyone. This is Mike Hebron, the Chief Operating Officer and one of the partners here at Level Financial Advisors, and I'm joined once again with my esteemed colleague, Mike Angelucci, CFP MBA extraordinaire.
Thank you.
And today, the topic that's on a lot of people's minds are tariffs. And we're getting phone calls from clients that are talking about, hey, what should I do with my portfolio? What's going on with these tariffs? If Trump puts a 25% tariff on Mexico and Canada, what's going to happen? So Mike, maybe the first thing we should do when we talk about this topic is let's explain a little bit about how tariffs might affect the overall economy if, and that's a big if obviously,
Right.
but if they're implemented.
Generally, tariffs can be a negative for an economy because what a tariff is basically a tax on an import. So let's say Mexico's importing or exporting a vehicle, a car that they assemble in Mexico to the United States. The United States at that point, as the vehicle is coming in, they would implement a tax on it. So if it's 25%, if the vehicle is $10,000, it's going to be a $2,500 tax. Now, what quite often happens is either that gets passed on to the consumer or Mexico will lower their price in order to try to continue to be competitive with that product.
And the idea behind the tariff, at least in theory, is that if you put the tariff on, they'll lower their prices and make it more competitive, and therefore, I guess, even out the trade imbalance between the countries.
Right, and the idea too is if they lower their price enough and we get that tax, then that helps with our tax revenues in the country. So theoretically, that's good. The flip side of that is that you are, in a sense, favoring industries in the United States that may be competing with Mexico, and maybe they're doing it well, and then can we do it as well as Mexico in time at the same cost to continue to be competitive? So generally economists don't like tariffs. I mean, this is something I learned 40 years ago, a long time ago, but it's always
back when you were 3 years old.
When I was
right?
3 years old, it's usually not in the long run a good thing, and that's why most economists haven't been in favor of the talk of tariffs. Now, I think you alluded to it. The issue is the market thinks that this is just rhetoric or posturing by Trump, that he's not going to go to 25 or 50%.
Yeah, clearly this week, the markets have responded favorably to the notion that, all right, well, his rhetoric has softened a little bit. There's a February 1st deadline instead of something that maybe was a little uncertain when he first went into office on Monday. So the markets have responded to that. They're pricing in the fact that they think that there's a likelihood, or at least less likelihood, that they could occur.
Yep.
But let's go with the premise that they do happen. What do you think the initial impact on the markets, on the broader markets, will be if next week we have a 25% tariff on everything coming in from Canada?
There would be volatility because it could potentially be inflationary. Inflationary means higher interest rates. Those are bad for stocks. So if that happens, that's what would occur. We would have some volatility in the stock market. Now, this in the first Trump administration, there's a lot of history of when he implemented certain tariffs and the stock market not reacting favorably, and then Trump and the Trump administration pulling back on the tariffs, and then the market reacting favorably to that. So it seems like, as we alluded to also, is that the market has already baked this in. Like everything you read in here, the overall market, investors have already are moving forward with the idea that whatever happens, if it's negative to the economy, Trump will do what he did in his first administration and back off. So a lot of it is he's willing to test the waters to see, what he can get away with economically.
What about when it comes to bonds? What's the impact of tariffs on the bond market?
The impact would be the inflation piece. So if tariffs do result in higher prices for consumers, that's inflationary, and you would see interest rates go up. Now, we're seeing the 10-year bond rates has been going up. It's up about 1% since September, and that's for several reasons, though. I mean, some of it is worry that if Trump does push the envelope, it could be inflationary, resulting in higher interest rates. We've also even seen data that shows that inflation has kind of plateaued and isn't going down further, and in some areas ticking up a little bit. So the market is thinking longer, higher interest rates for longer, but it definitely, if tariffs get implemented and stay, it could be inflationary, which would result in higher interest rates.
So if we get this, we've gotten this question several times this week from clients, nervous clients. Hey, I want to take my money out of the market because I'm nervous about these tariffs. I want to take a good chunk of my money out of the market and put it in something safe. What typically are we saying? And I know it depends on the individual needs, but what's the advice that you would give a nervous investor in this environment?
I would say, then this is the advice I do give is stay the course. I know it sounds cliche, it's the same old story, but with our investors, with our clients, we are structuring their portfolios so that their stock portfolio is money that they don't have to touch for many years. They've got stocks and bonds, and in some cases, we've got clients that hold up to a year's worth of cash because that's their comfort level. But the key point is that any money that we have that is invested in stocks for clients is money that they don't need to touch for many, many years. We're going to see a lot of different business cycles. There may be 2 or 3 presidents before some of our clients need to touch their stock money. So nobody's ever figured out how to get in and out of the market. Markets are very efficient. So far, they haven't been spooked by tariffs because of the things we said before. So even if we got out because we were fearful, and let's say things work out well or the markets go down a little bit and Trump backs off and then they get exuberant and go way up, well, we're going to be out of the market and we're going to miss that. So I always say to people, my analogy is, the stock market is like a yo-yo going uphill. If you're watching somebody doing a yo-yo going uphill, that's what's happening. It goes up and down, but over time it goes up because you have all these unknowns occurring and affecting markets day to day, and you can't hold your stock money for the short term. So you do nothing because you can't predict the ins and outs, and just make sure you're structured appropriately.
Now, I've heard you talk before about this whole idea of cash buckets and how that could be a tool that you could adjust in these types of times when people are getting nervous. Can you explain that concept a little bit?
Yeah, the idea is holding enough cash to ride out some storms. And in this industry, there's been a lot of studies, and a couple of years ago, there was a study in the Journal for Financial Planning that a few professors did that showed that actually a 1-year cash bucket is an optimal risk kind of holding. In other words, you don't need to hold 2 or 3 years worth of cash. If you have 1 year's worth of cash, that will allow you to ride out a lot of ups and downs.
Because so when you say that cash bucket, that 1 year, you're talking about, hey, how much money do I need if I had to spend a whole year's worth of stuff? Yes. That's the size of the bucket. So if it's $100,000, then your bucket is $100,000.
Right.
Okay.
Yep, exactly. So for example, with our clients, we look in the financial plan, we know that, based on our plan, you're going to need $50,000, $100,000 next year. Let's just keep that in cash. And you don't need to hold much more than that, because then it becomes inefficient. Then it becomes a drag on your investments, because the other part of your portfolio is we've got short-term bonds and intermediate-term bonds, and those bonds will stay fairly stable. And hopefully, if they go down for a little bit, they'll rebound within the year, so that after you're beyond a year, your investments, you should be able to draw on those again for your cash needs.
Okay. Anything else anybody should know? I mean, are there any potential upsides to tariffs that, in your opinion, could affect the economy or people's portfolios?
It would really have to be I would think lower tariffs, which would allow the other countries, manufacturers or producers, whatever, they're exporting to this country to adjust their prices and to allow us to collect on that tax. And assume that those other countries don't retaliate on us, because the other side of the coin is
a trade war.
it's a trade war, right? And then that hurts exporters. I remember back in the George W. Bush, I believe he put on steel tariffs. And there were stories in the Wall Street Journal how, this company that made steel barrels in Ohio had to go out of business because they could no longer afford steel to be competitive. So there's always a other side to the coin to these things, and that's the thing nobody kind of knows. But I'll reiterate the point. It sure seems from past behavior with the Trump administration, if things go bad, they pivot.
Right. Yeah. It seems like a lot of times the tariffs are being used as some form of leverage to get some other thing accomplished.
Right.
So we'll have to stay tuned and see what happens there. So I guess with that, we'll just end this short video. Mike Hebron, Level Financial. Mike James Lucci. Until next time, have a great weekend. Thanks. Bye.